Am I saving enough? Is my portfolio smart enough to make me wealthy? Am I on track to afford the best college education for my child? Am I buying the right insurance cover? How soon can I hang up my boots? If you have any of these questions, we have the answers for you right here on Let's Talk Money. Welcome everyone to your financial helpline. Call us or write into us at the numbers flashing on your screen and make sure you get a complete money makeover with us. On the show today, the Public Provident Fund investment limit has been increased to 1 lakh. Now, should you be exhausting this entire limit or are there better alternatives? Also, organizing your finances, your money life. Why is it so critical in making sure you never ever have to worry about money? Let me introduce you to my panelists today, Tejasvi Mohanram, CEO of rupeepower.com and capital4.com, Amit Kukreja, Certified Financial Planner. Tejasvi, Amit, thanks very much for joining me. We'll start with the PPF news. I'm sure all of you have read it, but this week Reserve Bank has also asked banks to start accepting deposits up to 1 lakh rupees under Public Provident Fund or PPF, as all of you know it. As many as 25 public and private sector lenders accept deposits under the PPF scheme. Recently, the government has raised the annual investment ceiling in PPF to 1 lakh from the existing limit of 70,000 rupees. Besides, just to jog your memory, interest rates on PPF have also been increased to 8.6% from 8%. Remember though, they are not sacrosanct or forever. They will be, PPF interest rates now will be linked to the interest rate environment in the economy. All right, and related to Public Provident Fund, we've got a question. Munish Kumar, 31 years of age, joins us from Mohali. Munish works in an MNC. His wife, Parvinder, teaches in a government school and they live in with Munish's parents. Go ahead, how can we help you?
Hi Manish, how are you?
Hi, good. Go ahead.
Okay, well this question is actually from my wife. I'm asking you on behalf of my wife.
All right.
She's working as a government teacher.
Okay.
So she draws about 26,000 per month. And what we actually we need help in regarding to the investments and as far as the tax benefits is concerned. Okay. As of now, she doesn't have any investments at all other than one PPF account wherein she deposits about 20,000 per month. Not actually per month. It's the total amount is 20,000.
Right.
And other than that, there are two recurring deposit accounts, and she deposits about 5,000 in total per month. Now we need help in order to save the tax, and we need to save around 80,000.
Right.
And other than that, she doesn't have any insurance policies, no mutual funds, nothing at all.
Okay, so in the question that you sent us or your wife sent us, she said she was considering either investing in PPF, Public Provident Fund, the entire 80,000 amount which she needs to for saving tax, or actually looking at insurance as an investment and tax saving option. Am I correct?
Absolutely.
Okay, so the toss-up is between insurance for tax saving or PPF, but I don't think there's a toss-up at all here.
There is no toss-up here. It's not an either or. Insurance and investment are two separate ball games altogether. Looking at where they are at the moment, it definitely doesn't look like they have any insurance. Do they have any insurance? It doesn't look like they have any insurance. So considering that his wife earns 26,000 per month, she should get adequate cover to the extent of about 50 lakhs. So for a start, she should go ahead and get a term life plan for roughly 50 lakhs over the next 30 years. That will cost them about 1,000 rupees per month. Second thing, the myth of insurance being investment. You can completely divorce insurance and investment.
Right.
With respect to investments, they need, so if they are going to spend 1,000 rupees in premium for term life, then they have another 6,000 rupees for investment. I would suggest they go ahead with their PPF and just increase it.
Right. So Public Provident Fund, but keeping aside. So my question again is at a different level, Amit. Does a wife need to be covered? She is earning equal amount as a husband in this case. Parvinder is earning as much as Munish, almost a similar amount. Does she need a term cover or just a term cover for Munish would be enough?
No, I think any earning member in the family, if the person has earning capacity, that person needs to be covered, because obviously when you have earning sources, you build up your dependencies on the earning sources. So naturally his wife needs to be covered as well.
All right. PPF, all of it, the 6,000 surplus that they have should go in Public Provident Fund. 8.76%, no tax, great, or almost the best investment option for long-term retirement planning.
I know, but it's 8.76% this year. You don't know what your percentage yields are in the subsequent years, because now PPF returns are going to be linked to market prevailing interest.
Right.
So if you want to fix the interest for next 5 years, you have the 5-year FD option as well. You can put a lump sum of 20K in the given financial year, or 10K, block that money for 5 years, and you can, you know, block your 10+% yield, because PPF is not going to be 10% fixed. I'm probably just repeating the same thing, because there is a dependency on the market interest rates,
So,
and here you have the lock-in
bank
interest.
deposits for more than 5 years are also eligible for Section 80C benefits.
Yes, they are.
And tax savings. So that's a very important point that you need to remember, Munish. You can actually shift some of your RD out as well. Parvinder can shift some of the RD out to a long-term bank deposit. That could be one option. She will get tax benefits there as well, and PPF. The rest of the amount can go into PPF. But remember, a term cover of 50 lakhs is something that you guys should consider. Amit Gupta joining us from my favorite city, Bangalore, and it is my favorite city because we get the maximum number of calls from Bangalore. Amit, go ahead. What's your money issue?
Hi, Manisha. So the first question will be regarding my home loan. So I have a home loan from SBI having outstanding of 40 lakhs.
Okay.
So this is associated with the max gain account. So my dilemma is whether I should put my excess fund in the max gain account and save the interest on the outstanding loan amount, or should I prepay some of the amount from the loan and get my debt free as early as possible? And if yes, then where should I invest the EMI saved for monthly, say about 10,000 per month?
Okay, very quickly, Amit, tell me what's the interest that you're paying on your home loan, because your SBI max gain would earn you the same interest which will be set off against your home loan, right?
Yes. So the EMI for the per month is around about 40,700, and the rate of interest for the current floating is 10.75%.
You're actually sitting on a very, very good product. I'm not really sure whether he needs to pay back his loan, Amit. I mean, if he can, the home saver accounts or the max gain new products which are there in the market, the beauty of that product is if you have excess money lying with you and that remains in the account, it earns the same amount of interest that you're paying on your home loan and gets set off against your interest and your principal payments. So does he need to pay off? And it's a very reasonable loan, 10.5. That's what he said.
Yeah, it's different schools of thought, you know. I am of the opinion, given his total loan as opposed to his total assets, I think the solvency ratio is still low. He needs to bump up his solvency ratio, which means his ability to pay back debt should be 3 times his loan amount, at least 3 times.
All right.
Since his total loan is for 40 lakhs and there is a total net worth value that I have here, I think the solvency ratio needs to increase, and hence I would recommend him paying off his debts as soon as possible. Plus this being his first home, I'm sure there will be emotional factors playing here. So it's good to have the first home debt absolutely debt free as soon as possible.
There's that mental peace that you have if you can repay and have a house which is completely in your name. Tejasvi?
I have a slightly different point of view here. I think cash is king. For all that they're saying, they're basically making the same amount of, earning the same interest as they're paying off on their home loans. Right now, there is a lot of uncertainty in markets, a lot of uncertainty in job markets. I personally believe that you should just keep the cash.
And use those opportunities to invest in the market or equity funds?
Yeah, equity funds, balanced funds. But for a start, keep the cash in the same account, earn the interest, or it will pay off some of the principal on a monthly basis. And then wait for the right opportunities to swing by. So you start off buying a balanced fund, or
start at the shallow end. Don't go deep, dive deep into an equity fund.
And or create a SIP and just buy on a monthly basis. And as the market, if the market were to tank from here, you average on your way down. If the markets go up, well, you're already in the money. The good part about SIPs is they traditionally give you better returns than if you were to invest at specific points in time, unless you are great at timing the markets.
And protect your downside as well. You don't need so much as you would in a lump sum investment. Okay, very interesting. 2 thoughts. And generally we like to give direct, straight answers, but sometimes there aren't no Absolutely right answers here. So Amit, if you want, or if you're one of those people who doesn't like debt on your head, you have a working wife, both of you can repay the debt, then go ahead and pay off some of your home loan. But remember, you're sitting on a very good home loan product. Most home loans have actually crossed 11%. If your home loan is still under 11%, 10.5%, and surplus money lying in that account will earn you the same amount tax-free and get set off against your interest and your principal repayment on that loan. I think you might also want to consider keeping some ready cash to invest in equity funds, balanced funds, as the markets actually soften a little bit to give you better rupee cost averaging. All right, today we'll also focus a little bit on a very critical aspect of everyone's money life, organizing it. That's correct. Your very first step to financial freedom is a very basic semblance of some order to your money and finances. Knowing how much money is coming in, where is it going? How much are you spending, and how much do you really need to save and invest? You know, I take one look around and find even the best of us get sloppy on this very basic first step. Think about the number of bills you've paid late this year, important papers you've misplaced, and of course, honestly, how many of you really make a spending budget every month? Not too many. There's a traditional theory, Amit and Tejasvi, that if you count your money too much, it doesn't stay in your hands. It's a Hindi saying, but yet when I look around and I ask a lot of youngsters, we in our organization have several kids under 30 working with us, young organization, and most of the time they say, where is the money to invest?
Well, I would like to flip that saying around, saying if you look at your money too much, it doesn't necessarily grow, but you won't lose it. The first thing for young people to remember is you normally don't have a handle on expenses, typically because you don't have the time to look at your expenses.
Right.
Two biggest constraints in life, time and money. So you don't have that one weekend off to actually take a look at
Money is becoming less of a constraint, but time is becoming bigger.
Definitely, yes. And the younger you are, it's a bigger constraint.
Right.
So they do not have the time once a week to actually sit and go through the expenses. I have been through that age, and you never really get down to doing it. The easiest thing to do is, instead of going for a savings plan, is to actually set off a particular amount that you're making every month as income, set it off as investment. You start with an investment target and you say, I am going to invest so much this month, you spend the rest.
All right.
So
that's at least to ensure that you're meeting some of your savings goals. But lots of times, Amit, you ask people, so where is the money going? And they have no clue. There are multiple bank accounts. There's money lying in several bank accounts which is earning nothing. There are demat accounts. There are stocks and shares lying in those accounts which they don't know of. They've forgotten. Markets go up, go down. They generally are not active traders, and they don't tend to keep a close eye on those as well. So there is this whole sense of, okay, I have enough money, and it's there. I'm not necessarily making the most of it because I don't know exactly how much is coming and how much is going.
I think I'll just connect two more dots to what Tejasvi just said. It's important for an individual to identify his significance for the money. If he identifies his financial goals and then attach it to the investments that he's doing systematically on a monthly basis, and if he focuses more on the goals as opposed to the liquidity in the bank, I think he will have a better feeling of peace, emotional satisfaction, and and self-worth. I think it's more about identifying the purpose, identifying the goals, and then following the discipline of making systematical investments towards those goals. And once these goals get fulfilled, I think the discipline will start automatically creeping in, and the retention will be off the liquidity in the banks.
How do you manage expenses? It's not cheap. Living today is not cheap at all.
Sure.
So you may think that you've just bought about 5 books in a month, but maybe you can't afford those books.
Set your budget.
Set your budget.
Set your budget every month for every specific things, day-to-day utility expenses,
You're saying
your
that
hobbies.
expenses, maybe you don't need to follow them every day, but you should know what are the big heads in which your expenses are going.
yes,
Absolutely.
there are some good software products out there if you don't have the time. At least 3 free portals where you can go, not exactly free, some of them might be paid now,
Yeah.
where you can actually go set up all your bank accounts, all your brokerage accounts, and they give you, and you can set a budget. So it
And
actually
even collate your demat account there?
Yes.
You can.
Yes.
So bank accounts, your expenses, your
Yes.
budgeting,
Yes.
your demat accounts,
Yes.
you could collate all of this.
Yes.
So it's a single window at which you look at the transaction.
Yeah. All of them have started from this legendary, or by now legendary in the software world, product called Mint from the US, where basically you set up a budget and you end up getting a message saying this is how much you have overspent on this part of your budget. You know, it's a very two-way system where you set up a budget and something comes back to you by the end of
So
the
it
month.
pulls you up.
Yes.
In a sense, it alerts you, it pulls you up in case you're overspending
Yes.
and says, don't do it.
Yes.
You will miss your savings target.
Yes. And that's a
Alright.
simpler way to do it. But for people in their 30s and 40s, I've noticed one thing. If you don't take that weekend off to take care of your expenses, sit with a spreadsheet or maybe use any software, your
Yeah.
kids never will.
You really think so?
Oh,
It
yeah.
is a habit-forming thing to be careful about money or your expenses and to plan it well?
I call it financial hygiene. As you maintain hygiene in other parts of the life, finances need the equivalent hygiene as well. So you need to keep a track of your expenses. You need to make sure they're not exceeding your limits. If they are, then how are you making up for the limits that you've overshot by?
All right, so that's it. You need to be smart about your money. You need to get a grip on how much is coming, where is it going. Overspending is easy, but saving is critical as well. So stick to your spending within a budget. Ensure you know how and where your money is. Set yourself some reminders for important payments. Collate all your e-accounts in one place, bank accounts, demats, to get a comprehensive look-see on how your financials are looking like. Next week, when we come back, we'll introduce you to a very smart banking product from ICICI Bank, the Money Manager, which helps you organize your money life and finances and wakes you up to some hard realities where if you are overspending, you will be pulled up. We'll be right back. Thanks so much for staying with us here on Let's Talk Money. We'll get going with a simple portfolio check for Bhavin Karwat. He's joining us from Baroda. Bhavin is a new dad and has sent us a very cute picture of his son and himself. Bhavin, I must say, very responsible father you are, already planning ahead for your kid's education. He's just been born, isn't it?
Yes.
All
he's 2
right.
months old.
Okay, go ahead. How much do you plan to save for his education? That's number one. And number two, are you planning for an Indian education or an external or a education abroad? I think a lot of our answers will depend on that.
Okay. I'm looking to save about 20-25 lakhs for his education
Okay.
and for an Indian education for his graduation.
Okay. For
And
an
a
Indian
further
graduation.
20 lakhs for marriage and other expenses.
Okay. Right now, you're not worried about your retirement, I can see. It's your son is your priority. So let's focus on that. 40 lakhs for his son, 20 for his marriage and 20 for his education. Number one, is the amount enough, Amit?
I think it has to be inflation calculation based. If the education cost for having a person complete his education in an engineering or medical courses in today's term, I think it's between 5 to 10 lakhs, depending upon what college he has chosen, whether it's a private college or a government-aided college.
Sure.
So if we go with the number that he would be needing 20 lakhs 15 years down the line for the education, I don't think that number is right if you factor in the 8% inflation number. So
Even if you moderate it to 6%, 8% we may not live with it. Even then, I don't think the numbers are working, Tejasvi, right?
I think the commitment has to be on two fronts. One is you start investing and you start investing diligently on a monthly basis.
Right.
But on top of that, you need to commit beforehand, I am going to increase this investment every year by X%. That commitment is extremely essential because going by the numbers, let's say 2,000 rupees per month, it's not going to cut it both for the education, even with the numbers that he has suggested. What I'd say is start with something like 2,250 and commit an increase of 6 to 7% every year.
All right. So you can start small. Not everybody has the capacity to begin big, but you have to remember that it has to take into consideration inflation. So your targets have to be aggressive. Go aggressive on your targets, whether it's for retirement or your child's future, and then save and also keep increasing it aggressively as much as you can. He's also sent us a portfolio, Amit: Reliance Regular Savings Fund, Reliance Growth Fund, Reliance Equity Opportunity. So he's got 3 Reliance funds, and HDFC Top 200. Seems like Bhavin, being from Gujarat, is quite fond of equities, has taken an aggressive position in equity funds as well. Anything to be changed there?
I think he has chosen good funds already. He has one multi-cap fund, he has one large and mid-cap fund, and he has chosen 2 mid and small-cap funds. I think he can stop the SIPs in Reliance Growth, and he can continue Reliance Equity Opportunities Fund.
Okay.
Reliance Growth has not been performing well lately. Plus the portfolio of 3 mutual funds across different, market cap. I think that's good enough to have Reliance Regular Savings, Reliance Equity Opportunities, and HDFC Top 200.
Okay. For his child now,
Yes.
we've told him, please start be a little bit more aggressive with your targets and also increase it every month. Where should he start? Is a balanced fund a better option than a equity fund?
Well, let's look at the seriousness of, there are 2 separate parts here. One is education, the other one is marriage.
Right.
Now,
But both long-term goals.
both are long-term goals, but one not necessarily as critical as the other.
Right.
I think the education part
Is very
is
critical.
much more critical than the marriage
Absolutely. And
part.
if there's no money left for the kid's marriage, he'd better find money for his own marriage.
Exactly. Exactly.
Why not?
Exactly.
I mean,
Maybe.
Indian parents believe they have to take care of everything for their children.
Yeah, maybe increase the education fund by 1.5 times, but that's one part of it. The second part of it is where the importance is higher, the risk should be lower, and where the importance is lower, the risk should be higher.
That's a good point.
So if he's going to break it into 2 chunks of 20 lakhs each, I would suggest that he goes for a more conservative fund, balanced fund, but more on the debt side
Right.
for the education part.
So
And,
HDFC Child Gift Plan is a
yes,
good one.
yes, it's a good one.
Yes.
He can go for that. And for the marriage bit, he can actually be a bit more aggressive. He can go for either a small to mid cap kind of fund as a SIP.
Okay.
There are some decent ones in that space.
Oh,
that is there.
absolutely. Yes. Gentlemen, thanks very much for joining in
Pleasure.
today. Amit, Tejasvi, pleasure having you. Next week, we'll come back with lots more interesting discussions and, of course, answer all your questions. The details are flashing on your screen, but our email ID at which you just need to send us your question with your portfolio is very, very simple. Can't get simpler than that. money@ndtv.com. I'll see you again next week. Goodbye.